Hooty hoo, all my stock market gamblers. Welcome today. I'm Tall Mike. So glad you're here. What do we got going on in the markets? Dow's up about 100, Nasdaq's down about 50. So the market's kind of flat. Nothing really extreme going on yet, but we may get volatility coming later today. It's options expiration day, and sometimes that can get a volatile move in either direction. Now, we've been in this bear market rally, and we've had a strong rally up, right? Just last week, we moved up 6%. Now, this week, we kind of been flat. Now, I keep expecting the market to pull back down and retest the recent lows. That's where I think the market's going. Now, why do I think that? Well, the market's in an overbought position right now. It's been led up by the financials, by the banks, if you will. The financials are at an extreme high. Now, if you go to the bullish percentage of the financials, that symbol is BPFINA. Now, you'll see that this bullish percentage is at 90%. Now, it can only go to 100, right? It's a percentage, but it's at an extreme overbought position. And this is usually where the top is formed, and this is usually where we'll get that pull back down, and we'll retest the recent low. That's my take on the markets. Now, I think that the markets are going to pull back before the end of the year. But see, a lot of times this is the strongest part of the year. Going into the month of December, we tend to drift higher into the end of the year. I'm not sure it's going to play out that way. I think we're very overbought, and I think that there's a disaster waiting to happen in the stock market. Now, can they push it off till the beginning of next year? I suppose they could. Perhaps we'll have a run up in the SPY up to the 200-day before we get the pullback. But I do think the market is overbought. I think you should use cautious here. I'm actually shorting the market to the downside. We'll see how that all plays out. Now, let's go over to the real estate market. Now, the real estate market is always fascinating to me. Now, once again, Yahoo Finance, I like reading their articles because they're so entertaining, let's say. So they say home buyers are rushing in to buy houses right now to take advantage, to capture the recent drop in mortgage rates. Now, what recent drop are they talking about? Well, mortgage rates were about 7.3%, and they've dropped down to about 6.8%. Now, that is true. It's a recent drop, but I don't see people running in. No, maybe I should start writing articles for Yahoo Finance. Yeah, I mean, maybe what would my headline be? Well, it'd be pretty much that the housing market has frozen over, right? I mean, the housing market's locked up. It's a standoff between the buyers and the sellers. Now, I know who's going to lose this battle. The sellers are going to lose. Now, why are the sellers going to lose? Well, even if the buyers wanted to go out and jump into this market to buy a house, they can't afford to. They can't qualify for the loan at these prices. Now, okay, we got prices still high, right? And we got interest rates high. Now, a lot of people think that interest rates are going to come back down. They think the Federal Reserve is going to lower the interest rates down to 0%, and that'd bring the mortgages back down to, well, that's called 4%. I think the mortgages are going the other direction. I think they're going to 8 to 9 to 10. That's my take on it. Now, the other thing could happen, okay, where the sellers lose and the sellers bring their house prices down. Now, that would make the houses affordable. Now, there's one other option, and that's the possibility that your wages continue to go up in price. They double from here, let's say, right? And then that would make homes affordable again. Now, I'm going to explain why I don't think that the wages, your wages in particular, are going to double from here. I don't see that happening. Now, okay, so the housing market has kind of frozen over, right? It's at a standstill. It's come to a grind. I know a lot of people in the mortgage industry. I know a lot of real estate agents, and they say that business is off about 50% this year. 50%. Now, that's a lot, right? Business has been cut in half, which means we're on commission. I'm a real estate broker. We get paid by commission. So it basically means our wages have been cut in half, right? We sell half as much as we sold last year. Last year was a banner year, right? House prices were going up 20% a year. They've done that for 2 years. They've done it for 2020, 2021, but this year they're down about 10% overall. Now, of course, in your area, they're still going up. I get that. I understand that. But overall, in most areas, the price prices come down by about 10%. Okay, so we're down about 10% so far, but that's not where the pain's coming. Look, the housing market has frozen up. The real estate market in general has pretty much come to a standstill. Real estate is very sensitive to interest rates, and with the interest rates going from 3% to 7% for mortgages, that is, it's frozen it up. It's cut the business in half. Now, real estate in general is responsible for about 18% of the GDP in the United States. 18% of the GDP in the United States is the real estate market. Now, the real estate market is frozen up. Okay, so 18% of the GDP. Now, this is about 14 million jobs. 14 million jobs in the real estate market are locked up. They've come to a standstill. There's no business. 14 million jobs. Now, if you just lose, 10 to 20% of those jobs are going to go away. Now, that would be between 2 and 3 million jobs lost. 2 and 3 million jobs lost just in the real estate industry. Now, granted, the real estate industry is a big industry, but a lot of other industry are having layoffs. And this is only the first round of layoffs that we're seeing so far. Amazon just came out today. Now, they're laying off, I forget the number, was it 15,000? I forget. But they're saying that that's just the start. There's going to be much more layoffs coming in 2023. Now, 2023, it's going to be a very ugly year for the economy. Think about it. Right now, 37% of small businesses aren't making their payments. They can't pay rent. They can't afford to. What are they going to have to do? They're going to have to lay people off. Now, Amazon says that they're going to lay additional people off on top of the layoffs they got going on right now. Now, they're laying these people off right before Christmas. Very sad. Hey, Merry Christmas. Here's your layoff notice. Okay, but that's what's going on. But they're saying 2023 is going to be worse. They're going to continue with layoffs. Now, Facebook, they're laying off 11,000 people, and they'll probably continue into 2023. But if you just took the real estate industry alone, right? 10 or 20% of the real estate industry is going to disappear. And that's 2 to 3 million jobs being lost. Now, why are wages not going to be able to go up? Well, when all these people are going to be out there looking for work, it's going to be a lot more competitive. The wages are actually going to probably go down. There's going to be downward pressure from all these unemployed people looking for work. They're going to be willing to accept a job that paid them less than the last job because they want to eat. Look, if you're making $300,000 at Facebook, you get laid off. Sure, you can go get a job at a restaurant, maybe McDonald's or Wendy's, and you can make that $15 an hour. But that doesn't replace your $300,000 job that you just had. It doesn't replace that income. No, it doesn't. And you know what? Unemployment doesn't replace that either. Unemployment does not pay $300,000. So a lot of these people, they have houses, they have mortgages, and they're not going to be able to make that payment. Now, when they can't make that payment, what are they going to do? Well, this is what's called the forced selling. Now, you're hearing a lot about forced selling these days. There's going to be so much forced selling in the real estate market that the prices are going to still spiral downward, right? Now, the Federal Reserve came out with the report. This is our own Federal Reserve, right? They came out with the report that says house prices are going to drop an additional 20% from here. Now, I'm just using rough numbers. Now, not in your area, but in most areas, we're down about 10%, and we're going to drop another 20%. So that's going to put us down 30%, right? Well, I say that number is going to be closer to 40 or 50%. It's going to be half off from the top. Now, a lot of people think I was crazy when I used to say that, but now that prices are starting to come down, they think, well, maybe Mike's not as crazy as I thought he was. Maybe we are going to get that 40 or 50% drop. But you got to realize a 40% drop just puts us back to the start of the pandemic before we had that 40% run up. But you see, people don't understand that the market was already getting soft before the pandemic started. Then they printed all that money, right? $6 trillion in 2 years. You put that money out there, sure, it's going to prop up assets. It propped up the stock market, propped up the real estate market, but now it's coming down. That 40% is going to be wiped out. It's going to go away. away. It's going to disappear, and we're going to overshoot to the downside. We might get 50 or 60% off of the highs. Now, granted, Jerome Powell, he came out and he says, look it, people are going to feel pain. Households are going to feel pain. Look it, it's painful when your main asset loses half of its value. Now, it's painful looking at your 401k right now. The 401k, the average is down about 23% just this year. Now, a lot of people go, oh, well, that's no problem. It'll just bounce right back up next year. I don't think so. I think you're going to see numbers next year that are going to be worse. So we're down, let's call it 20% this year. Maybe we're down 30% next year. That means your 401k just got chopped in half. A lot of people get upset with that because this is their assets. When assets start to go down, they feel bad. They lose their self-worth because their net worth is going down. Well, look, it's going to get bad next year. Next year's not going to be pretty. Now, I don't want to be the one to break that to you. Maybe, people today, Mike, just because, look, I have an economics degree, but this has nothing to do with economics. This is just common sense. Common sense will get out there and look at when people are getting laid off right and left. I mean, the layoffs are just being announced. The pain is not being felt yet, but the pain is coming. All right, so it's just common sense that things are going to be circling the drain next year. They're not going to be circling upward like we've done for the last couple of years. We're going the other direction now. It's going to take a lot to overturn this. Now, could the Federal Reserve come and print trillions and trillions of dollars? Well, of course they could, and they probably will. But you see, that's a problem. When they print the trillions and trillions of dollars, it means the dollar bills that you have become worth less and less and less. Every dollar they print, your dollar becomes worth less. So yeah, maybe we lose 30-40% only in the real estate market, but your dollars aren't going to be purchasing anything. They lost 20% just in the last 2 years, and that's what they're admitting with this inflation problem we have. But really, I know the inflation problem is much worse. So your dollars are losing a lot more than they are saying they're losing. So you combine the nominal price that houses come down with the loss in purchasing power. It's not going to be pretty. Now, I know I got carried away a little bit on a rant here on a Friday, but if you like this stuff, give me the thumbs up. Why not? Get out there, everybody. Have a great weekend. I'm Tall Mike. Hit that subscribe button so we can talk again next week. Bye-bye now.